Hey everyone, welcome to DIY Investing Education episode 2, and today we're going to talk about a term that you've probably heard before and definitely heard before, and one of the first terms you learn about when you start investing on your own: diversification. Gotta be diversified, right? But what does diversification actually mean? Well, in today's video, we're going to take an overview of 3 aspects of diversification. So by the time you finish watching this video, you'll understand, you'll have a high level overview of what diversification actually is. So the first aspect of diversification is asset classes. So let's go over some of the major and most common asset classes. First asset class, you have cash and cash equivalents. So just like the name says, cash would fall under this category, but also things like savings accounts, GICs, and sometimes very, very short duration government bonds would fall under this category. So this is really, considered the lowest risk asset class. It's basically cash and cash equivalents. The second asset class is fixed income, sometimes just referred to as bonds. So fixed income bonds, this is kind of like IOUs, right? You're lending someone money, either the government, either a corporation, and you're getting a fixed interest rate in return. So that's what fixed income or bonds really are. There could be government bonds, corporate bonds. There's other things as well. And the third asset class, and this is considered, one of the more higher or the highest risk asset class, is equities, sometimes just known as stocks. So these are shares in a public corporation, so that would be stocks. So equities is another asset class. Commodities could be another asset class as well: gold, silver, oil, which is really the price of commodities is really based on supply and demand. Timber, all kinds of stuff fall into the commodities asset class, I guess you could say. And then another one is typically called the alternative asset class, and typically real estate is in the alternative asset class. Some people view real estate as its own asset class, but alternative could be real estate, it could be artwork, stamps, collectibles, all that kind of stuff would fall under alternative. Maybe even crypto right now, because there's not much regulation, if at all, around crypto. Sometimes, or most likely, if you see crypto ETFs, they'll be classified as alternative. So maybe even crypto right now falls under the alternative asset class. So next section or next aspect of diversification is going to be stock market sectors. So there are officially 11 stock market sectors. So you have them right here. You have energy, materials, industrials, utilities, healthcare. So it's pretty self-explanatory, right? Pharmaceutical companies will fall under healthcare, electricity companies under utilities, gold producers, precious metal producers under materials, oil and gas under energy, industrials, think manufacturing type companies, financials, right? Banks, credit card companies, life insurance companies. For consumers, you actually have 2 sectors. You have consumer discretionary and consumer staples. So just like the picture shows, consumer staples is sometimes known as consumer essentials, like Walmart, for example. Then you have consumer discretionary, which is sometimes referred to as consumer non-essential. You have information technology as well, right? Tech stocks fall under that category, obviously. Communication services, things like Bell, Telus, AT&T, and you also have real estate. Real estate is also one of the 11 sectors of the stock market. So, for example, if you buy the S&P 500 index ETF or an S&P 500 index ETF, all 11 sectors or all 11 of these sectors are represented in that index. So there you have the second important aspect of diversification: sector diversification. And now the final one I want to talk about is regional diversification. So broadly speaking, you have a few regions that are considered generally the main ones. So you have Canada, the US, sometimes together it's basically the North American region. So you have certain index-based ETFs that cover regions in particular. So you have CNDX, for example, from Global X Canada, which is the S&P TSX 60 index, which is 60 very important companies or some of the biggest companies in Canada. I consider myself personally kind of like the S&P 500 of Canada. Then you have obviously the S&P 500, USSX is the Global X S&P 500 index ETF. So, Canada, US, definitely big regions. And together they could sometimes be referred to obviously as North America. But there's another two regions that are very important for you to understand. There's developed countries outside of North America. And a very big and popular index that represents this region is the MSCI. And by the way, MSCI, just like S&P Standard & Poor's, is another financials company, which is formerly known as Morgan Stanley Capital International, but they manage some big and popular indexes as well. So this one in particular follows or tracks this region here, the EAFE, Europe, Australasia, which is Australia, New Zealand, that area, and Far East. Basically, Japan makes up definitely the biggest region when it comes to Far East. So the MSCI EAFE Index ETF tracks over 750 companies, but here's the point. They are developed markets or developed countries around the world, excluding US and Canada. So if we look at a couple of countries, you have Japan makes up a big portion. A lot of European countries like the UK, France, Switzerland, Germany, Australia would be part of the list. So these are developed economies. Italy as well, developed economies outside of North America. And last but not least, another important region that you hear about is emerging markets. So this is the Global X MSCI, same company who manages the previous index, Emerging Markets Index ETF, EMMX. So this index based ETF from Global X tracks a lot of these developed or emerging companies around the world. So these are countries that are still developing, that are considered emerging markets. So this would be countries like China, India, Taiwan, South Korea, Saudi Arabia, a bunch of other ones, Mexico as well. So this is another region you need to be aware of. So there you have it, everyone. 3 aspects of diversification you need to understand. You have asset classes, you have stock market sectors, and you also have regions, regional diversification. So when you hear the term diversification, you'll know that basically these are the 3 main types or aspects of diversification. Make sure you send this video or this episode to friends and family who are still learning and are new to investing, because this is gonna be a series with over 20 episodes where we're gonna go over all the basic terms and the basic knowledge you need if you wanna become a do-it-yourself investor. Thanks for watching, everyone. Give me that thumbs up, hit that like button. I would really appreciate it, and see you next time.